It's the old downgrade and price hike. One of my favorite moves of the day or whatever with these analysts. But anyway, yes, exactly. There was downgrade to hold. Patrick Hummel at UBS saying that, you know what, shares are fairly priced here, right? Nice big move up. Q2 numbers, there was a kind of a hit there. Concerns about margins, but they delivered on Q2 deliveries, and the bull case is possibly intact through 2024 as part of one of the reasoning. So
we downgrade to neutral because we think the recent strong share performance fully reflects the strong demand response seen after price cuts, as well as a solid executive in 2024, UBS said of Tesla stock. This move was made ahead of the company's big Cybertruck production ramp. A few weeks ago, about a week after the company released its second quarter earnings results, UBS downgraded Tesla to neutral and argued that a lot of good news is already priced into the stock based on its near $1 trillion valuation and scorching 112% year-to-date rally. While Tesla beat profit and revenue estimates, its slide in automotive gross margins helped spark a more than 10% sell-off in the stock. Despite the downgrade, UBS still holds a bullish long-term view on Tesla and raised its 12-month price target to $270 from $220, reflecting a potential upside of about 3% from current levels. The new target is also 10.7% above the average target of the 46 analysts surveyed by FactSet of $244.20. We continue to see Tesla globally leading the race to affordable electric and autonomous mobility, but on a one-year view, risk-reward looks balanced, UBS said. However, the damage has already been done. After UBS recommended investors stop buying, saying prices already fully reflect strong demand, Tesla stock kept falling. Immediately after, UBS analyst Patrick Hummel cut his rating on Tesla shares to neutral after being at buy for the past 13 months, Tesla stock fell 0.5% in the morning trading, putting them on track to suffer a fourth straight decline. The electric vehicle giant stock has dropped 11.8% since closing at a 10-month high of $293.34 on July 18th, which many on Wall Street would say confirms a correction. Hummel explained, Tesla remains the undisputed truly global technology, scale, and cost leader in the EV space, with unparalleled software capabilities. However, for the next 12 months, we think upside risk to consensus earnings is very limited, with significant volumes from new products, first Cybertruck, then the affordable model, not kicking in before the second half of 2024, and with some initial margin dilutive impact. Hummel said he still tends to think of autonomy as a multi-year process, with a big financial upside only after full autonomy is reached. A bit of good news for Tesla investors, though, is that despite the correction, Tesla stock is still up 110% year-to-date. However, that's just a short relief to them, so to speak, as two more major Wall Street banks downgraded Tesla stock soon after UBS did. Barclays analyst Dan Levy downgraded Tesla shares to equal weight from overweight, claiming the recent rally ignored near-term questions about the stock's fundamentals. Though Tesla doesn't exactly trade on fundamentals, Levy made some interesting points about where Tesla stock sits compared to the month prior. We believe the stock's recent rally can be best explained by the market's current AI-driven thematic trade, as well as excitement over recent announcements to open the Tesla Supercharger network to other brands, Levy said in his note. Yet while we aren't surprised that the stock has participated in the rally, we believe it is prudent to move to the sidelines. Levy's main thesis for the downgrade rests on three main points. The AI effect may be overblown, Tesla's recent supercharger deals and uncertain benefits, and most importantly, how multiple expansion is really the entirety of the rally. Marking the third Tesla downgrade in July, Morgan Stanley downgraded Tesla to equal weight from overweight with a price target of $250 from $200. We're not trying to call the end to the Tesla rally, Morgan Stanley analyst Adam Jonas explained, and from our discussions continue to find a significant degree of investor skepticism, lack of exposure around the name. Jonas added that despite the downgrade, Morgan Stanley views Tesla as a must-own in an EV portfolio and as an industrial standard bearer for electric transport and renewable energy economy. Despite the recent rally, we expect material negative revisions for Tesla consensus earnings forecasts, Jonas told investors. Morgan Stanley forecast intensifying competition from China's EV players and slowing auto demand from consumers both present growing risks for Tesla stock. Jonas sees Tesla stock in a bull case hitting 450 and in a bear case 90 over the next 12 months. Analysts, who have been one of the most vocal Tesla bulls on the street in recent years, are now stepping to the sidelines after a massive rally in Tesla shares pushed valuation to fair levels. Recognizing the surge in Tesla stock due to the ongoing AI frenzy on Wall Street, analysts stated that the company is an AI beneficiary and an auto company. Following the trend was Goldman analyst Mark Delaney, who took Tesla shares down a peg, downgrading the stock to neutral from buy. However, in an unusual move, Delaney raised his price target on the stock from $248 from $185, while recommending investors pare back exposure to Tesla after more than doubling this year. For Delaney, the downgrade is pretty much a valuation call. While the primary reason for the change in our view is that we think the market is now giving the stock more credit for its long-term opportunities, we are also cognizant of the difficult pricing environment for new vehicles that we think will continue to weigh on Tesla's automotive non-GAAP gross margin this year, Delaney wrote. Delaney and the Goldman team cite a combination of factors explaining the recent run-up, a surge the firm said exceeded our expectations in terms of magnitude. The DZ Bank Double also downgraded Tesla stock to a sell rating from its previous buy rating with a $210 price target on Tesla. All that said, Tesla remains to be a key player in the electric vehicle industry, offering investors high return potential based on its positive cash debt balance and consistent growth in profit per share. However, nearly 20 analysts have downwardly revised their earnings forecast for the company, highlighting short-term risks. Additionally, Tesla's high price-to-earnings ratio, absent of dividend payments, and the stock's volatility are notable negatives. Still, there are several positives that Tesla has with which investors are willing to risk the negatives for. For one, Tesla is poised to win the price wars. Analysts at Goldman Sachs expect the EV market to represent a whopping 61% of global car sales by 2040. For Tesla, this megatrend is an opportunity to take over the industry, and it's taking the appropriate steps to make sure it stays ahead of the competition. Notably, many of Tesla's rivals are losing money, and the price wars will help ensure they don't threaten Tesla's lead. Tesla's management aims to halve prices on next-generation cars by unlocking manufacturing efficiencies. Simply put, the battle is just getting started. Another major thing Tesla has going for them is its energy business. On Tesla's 2023 Investor Day, Tesla executives highlighted a vision of becoming more than just a car company. Much of the presentation focused on lofty goals like eliminating fossil fuels from the electricity grid, electrifying non-traditional vehicles, and developing more efficient storage and transfer systems. But for Tesla, this is more than just talk. In Q4 2022, the company's energy generation and storage business saw revenue soar 90% to $1.3 billion, dwarfing the 35% growth rate in automotive sales. Orders are surging for Tesla Powerwalls and Megapacks, which are designed to store solar energy for households and reduce businesses' reliance on the electricity grid. Tesla expects demand to stay strong, so it's ramping up production at Tesla's dedicated battery pack factory in California. While energy is still a tiny part of Tesla's business, the segment is rapidly gaining ground. Its stellar growth rate means it could become a major source of revenue and diversification for the company over the long term. Another thing, Tesla's valuation is finally reasonable. Stock market investors must usually make a trade-off between company quality and valuation. For Tesla, this has historically been a difficult choice because its previously outrageous stock price has often overshadowed its excellent fundamentals. In late 2020, the company's price-to-earnings ratio soared as high as 1,120, while its market capitalization exceeded the value of the 5 next largest automakers combined. The good news is that Tesla's era of overvaluation seems to be over. While the stock's PE of 48 is more than double the NASDAQ Composite's average, this looks reasonable considering its rapid growth rate and strong economic moat against competition in its industry. Long-term investors still have the opportunity to bet on Tesla's continued success. Speaking of which, many believe that Tesla stock is indeed volatile, which may scare off potential investors, especially those looking for short-term investments. This is why experts, Tesla bulls mostly, have been explaining time and again that Tesla stock is a long-term investment. You are sure to get massive gains from it in the long term, not in the short term. That's one of the things that need to be considered before investing in the leading EV companies' stocks. Subscribe for more.